Hello, I'm Chris Didier of the Bear Generational Wealth Group, and welcome to our first quarterly market and economic update of 2024. I'm going to go through the material very quickly, and don't worry about that because my contact information will be at the end, my phone number and email. And if anything I say raises a question, feel free to reach out to me. Happy to answer anything that may come to mind. So let's get into it. Okay. So how did we do last year? Last year was a great year. I mean, for both more risky assets and for less risky assets, everything performed well except for commodities. So it was a terrific year. The S&P 500 led the way, up 26%. The thing that's interesting about that, though, is the Magnificent Seven, so stocks like Apple, Alphabet, Microsoft, Meta, Amazon, Tesla, Nvidia, they accounted for 60% of the return of the S&P 500 in the year. So if you didn't own those stocks, you probably didn't perform as well as the S&P 500 did. It's interesting because the equal weight S&P 500 was only up 13%. But the good news in the quarter was that the market broadened out. That's something that we've been looking for, and that's evidenced by small cap outperforming large cap. So small cap in the quarter was up 14%, which was most of its return for the year, because for the year it was up 17%. The S&P 500 itself, so S&P 500 in the quarter was up about 11.7%. The equal weight S&P 500 was actually up a little bit more, 11.9%. So that broadening is a good sign and something we've been looking for, and that is indicative of a more healthy stock market and backdrop. So if you followed us for a while, we always like to start with where are we in the market cycle. This is important because when we're in areas of euphoria, that's when you want to increase or decrease exposure to the market, increase liquidity. And when you're at areas of capitulation, that's where you want to increase exposure to the market and decrease liquidity. So we haven't really seen any capitulation for a while, and we really don't expect to see that until sort of the echoes of COVID, all of the Federal Reserve stimulus, all of the federal government stimulus. Till that kind of gets back to a normalized situation, it's going to be hard to have that capitulation. People just don't, there's too much support for the market in general. So we started the quarter at this area of fear, and that was after a pretty decent correction back in the summer of last year. So August to September, pretty bad months. Coming in October, the fear level had increased quite a bit, and we just kind of jumped over capitulation right here, given the market rally, to an area of relief. I mean, things didn't get any worse. I mean, the end of the year turned out pretty good. There was a lot of relief around the Federal Reserve sort of indication that maybe they were done with the interest rate tightening cycle. So maybe we'll start to edge up here to some area of optimism as we go through the quarter. Okay, another indication of how people are feeling about the world is the individual investor allocation of more risky assets. So actually, the average is running through here. That's right just below the 65% area, and people increase their allocation to more risky assets, which is suggests that they're more optimistic about the future. Capitulation, as you remember, happens down here. And so we know we're not in capitulation. We know we haven't seen that for a while, and we're not expecting to it. People get euphoric. There are levels up above the 70% area, and we haven't seen that yet either. So kind of in this no man's land. And that's the same thing that our valuation indicator is telling us. So we like to look at, we look at a lot of valuation indicators, but one that we kind of show everybody, and it's kind of a favorite of ours, is the cyclically adjusted price earnings ratio, because data goes back to a long way. It goes back to 1900. So this is just showing you 1990 to current, and the CAPE ratio is the light blue line running through here. What we pay attention to is the red line and the gray line. And the reason for that is when we're above this red line, the expected 5-year return going forward is just 3.9%. When we're below the gray line, the expected 5-year return going forward is 11.5%. Now, that says nothing about the ride that you would have, just the expectation. So things can get way overdone, they can get way underdone, and that all just depends on what happens in the short run. But over a 5-year period of time, that would be the expected return. Right now, we're kind of in this no man's land area still. We were close to the gray line at the beginning of the quarter, which was an opportunity to add to more risky assets. Now we're kind of just sitting tight. And so our conclusion for our clients would be just to stay put on their strategic or tactical long-term targets. And if there's any opportunity to add to things, if suddenly there's for whatever reason, a correction in the market or valuations come down, that would be more of a spot to add to things as opposed to anything different at this point in time. Okay, the thing that's driving our economy, driving the markets, really the wealth effect. What we're showing you here is household net worth is sort of a measure of that. Money supply is also on this chart. So the gray dotted line here, that's the trend in household net worth. You can see, you know, as a most recent reading, we're still well above trend. And that's really people's portfolio values, it's their home value, and that's really what makes up household net worth. And that's really what drives the wealth effect. So if those things are high, people feel better about their situation and more willing to spend and participate in the economy. The thing that's worth watching here is that the money supply was really what drove all this. So again, the stimulus that I talked about earlier, that's what drove the wealth effect to high levels, kept housing up, kept the stock market up. But the money supply was gradually coming down, which is what the Federal Reserve has been trying to do, and it's sort of flattening out here. That's something to keep an eye on, because while the money supply, which if you can think of the money supply as being sort of like gasoline for the economy, it's what makes the economy go, what makes the stock market go. If it flattens out like it is right now, that's good for those things, but really it's also what creates demand in our economy. And too much money chasing too few goods is really a recipe for inflation, which is what we've seen over the past as the money supply has stayed high. So we'll be watching that to see what happens with inflation as we go forward. Okay, so the consumption, this is what I've just said here. This is through November. So that's still right on trend. We expect December, which we'll see retail sales for December out very soon. But all the indications are that it was a really strong Christmas selling season. So retail sales we expect to do pretty well. And you know, when you see like wages that have been moving up 4 to 5% in that area, that's above where inflation is right now. So as long as wages are above what inflation is, people are going to feel better than they otherwise would. And so that's something that bodes well again for overall economic strength and you know, things moving forward. Inflation is going to be the thing that we keep an eye on. And there's, you know, the labor constraint is one that we've talked about a lot. Energy constraint is the other one. Those are the two biggest in the economy. What we're showing you here is the blue is actually actual inflation. You can see that has been trending down from the 8-9% that we saw back in summer of 22, where we got a little bit higher reading than what was expected just recently at 3.3%. But it's moving in the right direction. And if it stays on course, and again, these are year over year type numbers, and all we're doing here in the red is like taking the year over year. If everything stays constant, this is what inflation will be. And you know, out to March, we still are not below the Fed's target, which is 2%. And we expect it to stay sticky at levels above this. So if the constraints are actually stronger, in other words, you know, energy starts to go back up, oil prices go up, we might see some surprise in terms of you know, what the inflation is reading, which would probably not be taken well by the market or the economy. You know, one thing to keep in mind is that we saw this trend coming down in inflation, but you know, history tells us that that 87% of the time there's a second wave of inflation. Okay. So we'll have to keep our eye open for that. That would be something that, you know, so most of the market, you know, people, again, we always talk about people have investors, individuals, any participants in the economy have a hard time with cycles. Well, we're seeing the downside of an inflationary cycle right now. And really the expectation for most is that that just keeps coming. People forget, well, we could see another upside, another wave of inflation out there that would surprise everyone. And that's what we're kind of keeping our eye open for. Because some of the data we looked at, this is one of our indicators for inflation, Manufacturing Business Outlook Survey against CPI. And so you can see the dark blue line is the Outlook Survey. The light blue line is inflation. You can see that the dark blue line led the light blue line up. It's letting it back down the other side, but right here it kind of got sticky right here. And so that's what we mean by sticky inflation. And it hasn't kept going down. So we're going to keep our eye on that, because if we should see that, you know, come down, then that would be a good thing from an inflationary expectation. But if we see it start to continue to inch up here, then that's going to be something that we have to pay attention to, because we'll see inflation that would be surprising for most in the market. Okay, the big thing that everybody's been watching is really the yield curve, and it's one of the indicators that, you know, back in, remember the beginning of last year, towards the end of 22, most were looking for 23 for there to be a recession. it didn't materialize. And one of the things that they were looking at to say, well, we're going to have a recession was the yield curve. You see, like when the yield curve, so here's the zero line, and when the yield curve is positive, all these times up here, that's a normal yield curve. And the yield curve is negative, okay, like it's down here, that's what's called an inverted yield curve. An inverted yield curve is often an indicator of inflation. In fact, most of the time within 12 to 18 months, we have an inflation, or we have a recession. That's the gray bars. We have a recession that follows that inverted yield curve. And so that was why the expectation was for there to be a recession. Well, that yield curve is still inverted. So it's still telling us that there's a recession in our future. But one of the things you note about this is that you don't see the recession until the curve normalizes. Okay. So the curve needs to normalize yet for that to happen. What does that mean? So we need long rates to be higher than short rates in order for that to be a normal curve. And then we would expect the recession to follow shortly thereafter. Right now, long rates, 10-year rates are about 4%. Short rates are about 5.25%. So in December of last year, the Federal Reserve came out and said, well, we expect that maybe we'll see 3 rate cuts next year. The market priced in 6 right away, and that was why there was a lot of enthusiasm around that. But if you get 3 rate cuts, you go from 5.25 down to 4.5. It needs to go further than that in order for the curve to normalize. So there's a lot that has to happen before that comes. So if we were trying to guess, we'd say, well, maybe late this year, more likely 2025, because that's when, from a probability standpoint, that's when most recessions occur in the first year of a new president's term, and 25 will be the first term for the next president. And so that would be, if you push this in a corner, what we would say, that's when we would be most expecting some kind of recession to happen. But given all that cash that's out there, we still expect that to be kind of a more mild type event. So, why do we think interest rates might have trouble coming down? It's really because it's quantitative easing. So you can see this is where quantitative easing started back in 2008. Prior to that, for 15 years, the 10-year average is about 5.4%. Following quantitative easing, it's averaged about 2.5%. And that's because the Federal Reserve had dumped $9 trillion roughly into buying bonds, buying treasury bonds, mortgage-backed securities, et cetera, until the point where they were the largest owner of those securities in the marketplace. So when you have a big buyer, what does that do to bond prices? That sends bond prices up. And when bond prices go up, interest rates go down. Well, we can see what that did all through this period of time, kept rates low. But right here in 2022, the summer of 2022, the Federal Reserve stopped that program. In other words, they started letting bonds roll off, and they weren't no longer a buyer. So when a big buyer leaves the bond marketplace, what does that do to prices? Well, prices go the opposite direction. So prices go down and interest rates go up. And so that's what we've seen here. Interest rates moved all the way up to 5%. They did come off a little bit of that because, that's probably the kind of a peak area there. But, when we look at long term, where do we see interest rates? Well, you kind of come back here and you say, well, this looked like kind of a reasonable spot for long-term rates to be in this range, maybe 3.5 to maybe 6.5 on the upside. Now, 6.5 would surprise a lot of people. We're not expecting that anytime soon, but that would be a more normal range as long as the Federal Reserve stays with their policy of ending quantitative easing. Now, keep in mind, if there's any crisis that comes up, just as with Silicon Valley Bank, we saw the Federal Reserve come right back in very quickly with quantitative easing, and we would expect that to happen again. Another thing that we look at is that in the next year, 34% of our debt, our federal debt, needs to be refinanced. So it bodes the federal government to have interest rates lower so they can refinance at a lower rate, but they may not get the market to cooperate with that. So we may be refinancing that debt at a higher rate, but at the minimum, we know that there's more supply of bonds coming out. Again, when there's more supply of something, what does that do to prices? It means prices go down and rates go up. And what does that meant for the dollar? Well, we can see. So the dollar kind of moves in this sort of cyclical fashion. So we're expecting a cyclical decline in the dollar. That would make sense if interest rates start to come down. You'd expect a cyclical decline in the dollar. If interest rates don't come down, the dollar may stay strong, but it's all relative to what's happening to other currencies. The reason to pay attention to this is because during a rising dollar environment, stocks do quite well. But in a declining dollar environment, they don't do so well. So back in the 2000s, the S&P 500 averaged a -1% annualized for 10 years. Now, I don't think there's many people out there that are prepared for that to happen, which makes sense to have some hedge in it because things like gold and oil, emerging markets did well during that environment because those are things that kind of move opposite to the direction of the dollar. Right now, though, we're seeing something kind of unique because China makes up 34% of the emerging market index, and we expect China to continue to be a drag on emerging markets because of they have a very slow coming out of COVID. Their economy's got a lot of debt internally, their economy, and also just with the way the government sort of cracked down on some of the embers of capitalism that we're starting in the country. They've kind of firmly become a communist state and control oriented. And so that's really kind of hurt their economy long term. And we expect that overall in turn will be a drag on emerging markets. So ex-China, emerging markets good, with China, not so good. Okay, big picture. We've talked about this a lot. So in our country, we're blessed to have three big population groups: the baby boomers, millennials, and Gen Zs. And that's really the big thing that's been driving our economy. Other countries around the world, whether it's Europe, Japan, China, they didn't have the millennials and the Gen Zs, not in at least the quantity that we have them here. They all had a kind of a baby boom population, but that's something that the United States has got going for it that other countries don't. So that bodes well for our economy over the next many years. And where it becomes a concern, though, is that when you look at the average age of the baby boom population, it's 67 years old today. And so as we get out to the 2030s, so as we go through that decade, the average age for the baby boom is going to be up above 70, and that's going to be difficult. By the end of the 2030s, so by 2040, the bulk of the baby boom population is going to be gone. And so as they leave us, that's going to put a lot of, it's going to put a strain on our economy, because if you think of each person being a unit of demand, and as those units of demand leave us, that's not as strong for the overall economy going forward. So, we need the millennials and the Gen Zs to pick up a lot of that slack, and maybe AI or technology or something else will come in to help. But at the very minimum, we have to watch how this transpires and make sure that if this does have an effect on the economy and corresponding portfolios, we have to make sure portfolios are positioned accordingly for that environment. So as I said at the beginning, feel free to reach out to me with any questions. There's my phone number. You can send a text to me at my office phone number as well. My email address is there. But in general, from a big picture summary standpoint, the market is in pretty good mood. I mean, driven by a stronger than expected economy. We expect earnings to be pretty good. Markets either over or undervalued. So from a strategic standpoint, pretty much stay the course, look for opportunities to bring up the allocation if you can. And this is, continue to be driven by wealth effect. One thing that we have to watch going forward is that, with the interest rates and the yield curve, is there a potential for recession? Keep an eye on where that starts to develop as we go through this year. And bigger picture, just, what happens with the 10 years, over the next 10 years from a demographic change standpoint. That's very important to keep an eye on. And also, I didn't mention it, but the big kind of thing weighing through this is the resurgence that we expect sometime to happen for a second wave of inflation to happen. So we'll be keeping an eye open for that as well. So with that, we'll see you next time. If any questions come up, please feel free to reach out. Thank you very much for your time today.